Hey everyone, today we are going to talk about two companies that from their recent filings seem to have good potential ahead. The first one is an AI-driven surveillance provider has bagged one of its largest order yet 85 crore from Rail Vikas Nigam to deploy video security systems across 484 southern railway stations. And the second company is a hospitality player is scaling its premium IRA by Orchid brand in North Goa with a new 43-room property, adding to its asset-light growth model. So basically, both companies are expanding steadily through government-led orders, strong order book visibility, and opportunities in airports, metros, and smart cities. And the other scaling through asset-light expansion, premium positioning in high-demand tourist hubs, and long-term targets of rooms and revenue growth. So, welcome to the another edition of Noisemaker, where we keep things simple and talk about companies that may not always be in the spotlight, but have strong potential for the future. I'm Deepali, Equity Research Analyst at Desvelado Advisory, and today we are going to talk about two companies that are making solid progress in their business, and if current trends continue, they might keep growing even further. But before we begin, here's a quick disclaimer. Any discussion, facts, or writing provided are for informational purpose only and do not constitute a buy-sell recommendation. Please conduct your own due diligence before making any investment decisions. So let's move to the first company. The first company is Magellanic Cloud Ltd, an IT service provider engaged in software development, consulting, and HR business solution. The company also operates in the smart surveillance space through its wholly owned subsidiary Provigil Surveillance Ltd. Recently, they bagged one of their largest order yet, worth 85 crore from Rail Vikas Nigam Ltd to deploy AI-enabled video surveillance system across 484 stations in the southern railway zone. On the top of that, they also secured a 2.2 crore order from South Central Railway Ltd, upgrading surveillance at Secunderabad station. Together, these back-to-back projects of 87.2 crore contribute nearly 14.6% of FY25 revenue, providing strong visibility of earnings. And if we add the earlier 32 crore NHAI project, the total government order book now stands at 119.2 crore, showcasing their proven expertise in building smart, cyber-secure infrastructure solutions. What's interesting is the management has guided that these wins could open new opportunities in airports, metros, and smart cities going forward. Now, talking about the numbers in FY25, revenue stood at 597.2 crore, up 6.6% year on year from 560.4 crore in FY24. Growth was steady across quarter, with Q2 being the best at 19.1% quarter on quarter, Q3 dipping slightly by 3.8%, and Q4 rebounding with 3.2%. EBITDA came in at 209.7 crore versus 201.2 crore last year, but margin softened a bit to 35.1% from 35.9%. Net profit was almost flat at 102.7 crore versus 102.9 crore, with margins dipping to 17.2% from 18.4%. So overall, a stable top line and operating performance, but the earnings stagnation clearly signals that need for stronger growth drivers. Now, Mudit will be joining for more. So, Mudit will be joining. So, Mudit, what's your take on how these recent order wins could shape their growth story?
Thanks, Deepali. What stand out to me is how these government project wins are creating a solid base of visibility. The 85 crores RVNL order is a major milestone, not just in size but in positioning the Magellanic Clouds as a trusted partner in AI-driven railway security. When combined with the NHAI project, it reflects their ability to deliver large-scale mission-critical solutions. Now, if you really look at the financials, then even though I would say that net profit was flat, the company still managed to sustain industry-leading EBITDA margins of 35%, which indicates strong pricing power in niche segments like surveillance. The challenge, as you rightly pointed out, is scaling revenues consistently to lift profitability further. That's where the global expansion and product pipelines comes in. Like their subsidiary Multibagger Labs has partnered with the Snowflakes and Databricks, and that significantly strengthened their cloud, AI, and advanced data analytics and offerings. This is going to be open up higher value international revenue, especially in the US and Middle East, while diversifying away from India only earnings.
So, absolutely. And what excites me further is the Scanatelix video intelligence platform, which is now evolving into a full fledged surveillance OS. It has even received STQC certification from the government of India, which is a big deal because it makes them eligible for large PSUs and government lenders. This could translate into steady recurring revenues from high value contracts. So, in my view, Magellanic Cloud's growth runway looks strong on three fronts. Government project momentum already at 119 plus crore and expanding into airports, metros, and smart cities. Global diversification via Motivity Labs partnership in cloud and AI. Product-led growth, Scanaltex evolving its scalable surveillance OS and with PSU adoption. So, Mudit, do you think their execution discipline is enough to convert the strong order book into sustainable earnings growth?
That's a good question, Dipali. I would say yes, provided they keep a sharp focus on operational efficiency. The order wins are impressive, but the real test will be how effectively they execute without letting margins slip further. Now, if they manage that, these wins could help reignite earnings growth after a flat FY25. So, to sum it up, the Magellanic Cloud is positioning itself well through a robust order book that adds visibility and credibility. Now, if we talk about the diversification into the global high value markets, then it actually has a plus point in it. And if we talk about the third thing, that is a product link strategy. So the product link strategy with the Scantelix for recurring revenues. So the thing is, if the execution stays tight, they could transform from being just another ITHR services player into a leading smart infrastructure and surveillance solutions provider in this.
Okay. So now let's move to the second company, Kamat Hotels Limited, which is part of the Kamat's group. KHIL is engaged in the hospitality business and related services like hotel, consultancy, and setup. The company operates with a diversified brand portfolio with premium brands like the Orchid, Fort, Jadhav, Cut, Mohaddi Place, Toam, and mid-premium offerings such as Lotus Resorts and IRA by Orchid. Recently, KHIL signed an agreement to operate its second IRA by Orchid property in North Goa. The hotel will have 43 rooms, banquet halls, two restaurants, and a health club. The idea a high demand leisure and event driven market with a strong tourism and wedding conference demand. Importantly, this expansion follows an asset light model, allowing them to scale without heavy capital outlay. The property is expected to open by September 30, 2025 and should contribute meaningfully towards the company's FY26 target of 2500 operational rooms. It will also support their FY26 revenue guidance of 400 crore and 500 crore in FY27, while reinforcing the IRA brand in a key leisure market. Management expects this expansion to help capture event-driven demand and maintain stable EBITDA margin of 29 to 30%. Talking about numbers, in FY25, KHIL delivered a solid performance with revenue up 17.3% year on year to 356.9 crore versus 304.3 crore in FY24. Growth was particularly stronger in Q3 at 110.8 crore, 29.9% up quarter on quarter, but momentum softened in Q4, which declined 16.7%. Sequentially, EBITDA improved to 104.7 crore from 90.9 crore with margin steady at 29.3%, reflecting good cost control. Net profit came in at 46.6 crore, a small uptick from 44.8 crore last year, though margins moderated to 12.8% versus 14.2%. So overall, FY25 showcased healthy top-line growth and resilient operating margins, but earnings momentum is towards the end of the year. So, Mudit, how do you see these expansion plans shaping KHIL's growth story?
Thanks, Dipali. I think what's interesting here is that KHIL is really strengthening its footprint in high demand destinations. The new IRA by Orchid in North Goa is not just about the adding rooms, but it's about reinforcing the brand presence in a premium leisure events hub. What also stand out is the pipeline of new properties in locations like Rishikesh, Dwarka, Hyderabad, Dehradun, and Gwalior, along with the upcoming expansions in Puri and Lotus Konark. This is clearly aligned with their strategy to increase room inventory and capture leisure or event driven demand. So, if we look at the financials and maintaining, it's actually, I would say, maintaining 29% EBITDA margins in a capex heavy industry is commendable. And yes, the Q4 dragged earnings, but the discipline in operations is very visible. Another key point in that is that their debt management. With debt at around 95 to 98 crores and interest costs at 10%, nearly 10%, they are consciously working to bring this down below 9%. So lower finance costs will directly aid profitability and strengthen cash flows, which is actually, I would say, crucial for sustainable growth in hospitality.
Absolutely, Mudit. And I like the fact that KHIL is now focusing on selective larger properties with 100 to 300 plus rooms in top tier locations. The strategy should drive higher average daily rates and improve the performance of its premium brands like Orchid. To sum it up, KHIL's growth look like supported by three levels: strategic asset like expansion into high demand markets like Goa, scaling through larger inventory properties in a key tourist and business hubs, disciplined debt and cost management, ensuring sustainable margins and profitability. So, yeah, Mudit.
Exactly, I would say, like, if they actually execute it well, the KHIL can move from being a mid-sized hospitality player into a strong, well-diversified hotel chain with a balance of premium and mid-premium brands. So I would say with steady EBITDA margins and a growing portfolio, they are well placed to benefit from India's structural growth in domestic tourism and event-driven hospitality demand.
Thanks a lot, Mudit. That really helped us understand the direction both these companies are moving in. All right, now let's take a quick look at how some of our previous picks have performed. So the first company is Vimta Labs Limited. We picked that is rupees 481.5 and it's now at 669.8, giving a return of 39.1%. The next is Jupiter Lifeline Hospitals from 1499 to 1427 rupees. That's a 4.8% decline. And the third company is Late Revenues Technology Limited. It moved from 194 rupees to 278.5 rupees, delivering a strong 43.6% gain. And the fourth company is MES Financial Services Limited. This one slipped from 324 rupees to 314.9, which is a 2.8% decline. And the last company is Alpex Solar Limited. We picked this at rupees 1205 and it's now at 1305, giving a return of 8.3%. So overall a pretty good mix of gains, and we'll continue to monitor all these companies closely to see how they shape up in the coming quarters. Here's the QR through which you can access all the previous picks covered recently. Now let's see the summary of our today's recent filing. The company covered today is the first company is Magellanic Cloud. The company, through its wholly owned subsidiary Provigil Surveillance Ltd, has recently received a significant 85 crore order from Rail Vikas Nigam Ltd. And the second company is Kamat Hotels Limited. The IE company has signed a management agreement to operate its second IRA by Orchid property in North Goa, comprising 43 rooms, banquet halls, 2 restaurants, and a health club. Thanks. That's it for today's edition of Noisemaker. If you found this breakdown informative, you can scan the QR code to read the full report. We'll back soon with a more simple and clear market updates. Until then, stay curious, stay informed, and stay ahead.